Good morning, everybody. Thanks for joining us on how to build a hospitality group. I'm David Helbraun. I'm here with Andrew Fine, who is our partner and chair of the corporate group, and Dimitre Krouchev, who is the director of corporate finance for Paperchase. And if you don't know Paperchase, they are a bookkeeping and accounting service for the restaurant industry. We share a ton of the same clients. They are as deep into the industry as we are, and we're really happy to have everybody. So we'll, I don't know, take a second or two, kind of wait for everyone to come in. Um, I see a lot of familiar faces here. Hi, Caroline. Hi, Colin. Um, it's always fun to see our clients joining these because this is our most popular webinar by far. This is probably, I don't know, the seventh or eighth time we've done it, Andrew.
Mhm.
And it's complicated. So it makes sense to come back more than once to try to understand what we even mean by the term hospitality group. It's got a lot of different meanings to different people, but we're going to get into it and talk about how to build one because these days, as we all know, and we learned during COVID, you can't just build one restaurant. You got to build a bunch of them. The margins are just too tight. And if you start thinking about the restaurant business as a business and as a group where you can have different tentacles reaching different markets, you'll be in much better shape, whether it's opening multiple units of the same brand, whether it's getting into licensing and management deals, CPG, it all kind of falls under hospitality group. So I'm very excited to get going. I think our room is filling up very quickly. We have a lot of people here. So I'm going to get started. Um, the first thing we always do is everyone's favorite part, which is the legal disclaimer. There's no way I'm going to read all this stuff. So I'll just tell you that what we're going to talk about today is not legal advice. It's informational. If you want legal advice, give me a call. Let's get going. So, what is a hospitality group? Andrew, you want to get us started?
Sure. A hospitality group, in short, is a series of bars, restaurants, hospitality outlets under common ownership and management, right? It's a broad term. It's not necessarily talking about a franchise. It's not necessarily talking about a group of, identically branded concepts. It's basically talking about a bridge between concepts that have the same or substantially similar ownership. And I think it's a definition that trips people up sometimes because you might think, well, I have four restaurants, but they're all different from one another. So I don't have a hospitality group. You could very well have a hospitality group if you create what we'll talk about in a minute, which is a parent company over those four concepts. They don't have to be called the same thing. Basically, it's just a way to consolidate the beginnings of, hospitality empire. There are a lot of reasons why you would want to form this. As David mentioned, these are becoming increasingly popular, right? For better or for worse, economies of scale are kind of becoming king these days, and margins are tough in hospitality. They always have been. They're becoming increasingly so. So our clients and hospitality owners across the country are hungry to save a little bit of money, right? And to try to protect those margins. Creating a hospitality group lets you do that for a variety of reasons. We'll talk about these a little more in more detail in a few slides. But the theme of this presentation is really going to be trying to leverage economies of scale to get you better deals, both with vendors, with banks, with landlords. We'll go into all of that, but
What does that mean,
um,
Andrew? What does the economies of scale mean to you?
it means that you have if you're imagine put yourself in the seat of a landlord or a lender. Um, if you're dealing with a restaurant owner who has eight concepts, you might look at that restaurant owner differently than the owner of one concept who has no experience.
Hmm.
Right. And as much as we like to think, oh, it's all equal opportunity regardless of how much money you have, it's really not in the economic world, right? If you have a lot of assets already, success builds on success. It's like basic economics, right? If you have money, it's easier to make money. And the
Hmm.
same goes for hospitality groups. If you are selling equity, for example, to an investor in a hospitality group that owns five restaurants, that is a way more attractive proposition than trying to sell equity in a company that only owns one restaurant that hasn't been proven yet.
Hmm.
So these are examples of situations where you can, uh, at the risk of overusing this term, leverage. your brand and your scale to get better deals. And I think you'd be surprised the variety of arenas, right, where you can do that with
Hmm.
banks, investors, with with landlords, even with your vendors. You can get bulk sale discounts if you're ordering, napkins for 5 restaurants as opposed to one. You're probably going to get a better deal.
And just to put some numbers behind that economies of scale context, we often do see clients immediately make savings of about 6 to 8% of their total sales, based on purchasing bulk discounts. So vendors love working with growing brands because they know that there's more volume in the future. So it just gives you more leverage to negotiate at an earlier stage in your growth plan.
Yeah.
So talk about that for a second, Dimitri, because a lot of our clients have one, then they go to two. It's
Yes.
onesies and twosies. We'll go
Yeah.
1, 2, 3. At what point does it become more profitable where you can actually talk to Baldur or
Hmm.
some of your meat and fish guys and get
Yeah.
prices?
Yeah, generally the first site is always still pretty limited, but as you starting to get to two to three, you've already proven out that you have enough demand to open up that second location. But
Mhm.
even early on, if you're establishing that growth plan and you have a good track record, maybe in your prior CV that you've worked at well-established larger hospitality groups, they want to start building a relationship with you earlier so that when you head into the 4 to 5 location growth plan, they're going to be one of your key suppliers. So generally, we see good time to negotiate around location 2 to 3. And even earlier on, companies such as ours, as example, if we know that there's a growing plan, you're going to get pretty good shared service discounts at, your kind of professional fees cohorts. And a lot of those fixed type charges where if we only see you as a single location, the pricing may be a little different.
We're always digging for points. That's what I call it, digging for points,
Yeah.
I mean, profit points, because it's a big difference between 6 and 7 and 10. And we all work so hard in the industry that we want to be a 10 plus. At what point do you reach out to your vendors? How do you negotiate that? I'm curious to hear from someone who does it for a living.
Hmm.
Conversation like,
Yeah, you basically lay out a timeline, of your opening plan and your future volume, and you, like you said, just kind of working towards some basis point improvement, which is just fancy word for margin improvement, across your P&L. So often on repairs and maintenance vendors, we just elaborate that, as we scale, there's going to be some older locations, and we want to work our way down on some of the cleaning maintenance, some of the equipment maintenance. Also helps with equipment leasing vendors, where you can perhaps get an improved loan requirement in your earlier years versus your later years.
take
So
me through a conversation with
yeah,
Baldur. Call Baldur. We've
yeah.
got 2 locations we're about to open up our third and fourth. What's that
Mhm.
conversation sound like?
Yeah, so we generally open up with looking at like our most recent 3 to 6 batch of invoices. And we've also done a little bit of a market comparison review at
Okay.
Paperchase where we will understand our low, medium, high.
Hmm.
And we will frame the conversation of, okay, this is our current volume, with you in 3 to 4 years, our volume will be 4x this amount.
Hmm.
Can we work on, um, improving our margin, at least by a percentage point with the recent batch of invoices that you have
So
provided
you're
us with?
asking, you're straight up asking for a point.
Yes, yeah, yeah. So we will obviously, we know like the average price per pack size or recipe item, that
Uh-huh.
we will back into that discount for that amount. So
I
we
like
will
that.
request, generally we use the 3 vendor rule. So we will have 3 comparable vendors that we know, okay, this is where we can frame our negotiation, and we just start the discussion. We also speak to the client, who's your preferred vendor, who do you really like.
Sure.
So it's an open dialogue where we don't want to also step on the vendor's toes too
Sure,
much
sure.
as well.
No,
Yeah.
that's very interesting. It's interesting to hear how the conversation actually goes so our clients understand the best way to approach your vendors to get those discounts. Andrew, do you have anything else you want to say about hospitality groups before we move on?
Nothing at this stage. We're going to get into some of the more, the nuts and bolts of what some of these advantages are. So I think that's enough to whet appetites for right now.
Okay, let's do it.
Yeah. So part one here is when you're thinking about a hospitality group, you want to start by building your infrastructure the right way. That means that for every one of your locations, every time you sign a lease, every time you sign a management agreement, every time you have basically a new and separate line of revenue coming in, generally speaking, you want to form a new company for that line of revenue, for that business line. The primary reason for that is you want to insulate liability, you want to insulate risks across your different concepts.
What does that mean, Andrew? What do you mean insulate liability and risk? Give me an example.
If you sign, I'll give you, yeah. So we had a client sign, unfortunately, they signed two leases in the name of the same LLC. They ran into an issue with the landlord. They're embroiled now in litigation with that landlord, and the landlord wants to collect rent from both of those, from a company that has two businesses in it. If they
Mm.
had just formed a separate LLC for that separate restaurant that had the problematic landlord, worst case scenario, you're closing one restaurant, and the other
Right.
restaurant that predated it lives on and is fine and is completely insulated or protected from the issue going on with the other one. The more
So
time
each
that
LLC is a world into its own.
exactly.
And if anything bad happens to one of the LLCs, it doesn't affect the other ones, right?
That's right.
Okay.
And David mentioned LLCs; those stand for limited liability companies. I know most people in the audience right now know this already and have probably a half dozen of them already, but it's worth mentioning because when you're forming companies, you want to form a company that offers limited liability protection. What does that mean? That means the debts and liabilities of the company stay with the company. They don't pass on to you as the owner. And that is the general rule. There are exceptions to that rule in the form of personal guarantees, which I know a lot of people on this call in this webinar know all too well. But the general rule is debts and liabilities of the company stay with the company. And that's one of the most attractive features of something like an LLC or something like a corporation. The
Dimitri, when you're building your infrastructure,
Mhm,
Andrew, thank you for the LLC
Yes.
tutorial.
mhm.
Certainly, we need to do that. Is there anything that we need to know from like step one and building this hospitality group? We're going to build our infrastructure. Anything I need to
The
do
key, the
on that?
key,
Go
yeah, the
ahead.
key footnote is to really not set up S corps. A lot of owners, especially in the early stages, do think it's a good tax saving for their personal um, tax returns, but in the long term game, rolling up an S corp conversion to a C corp can be first of all expensive, involving SPNA, CPAs, and legal firms such as you guys, and it just kills deal momentum in a fundraise where you have to handle this administrative issue.
Sure.
So C corp LLCs are amazing for tax pass-through entities to personal owners in the business, and then the holding company that we're going to touch on
Yep.
coming forward. Yeah.
Great. Anything else you want to say about LLCs, Andrew?
I could do a whole webinar on why I prefer LLCs over corporations, but I think Dimitri gave a great synopsis there. Just know that if you have an S corporation, it's very hard to fold it into the broader structure that we're going to be talking about in a few slides. Basically, if you think of companies as like Lego bricks, LLCs can be stacked on top of each other very nicely, and you can basically create whatever infrastructure you want with them. S corporations, you can't really do that very easily. We're dealing with a number of roll-ups and restructurings right now that should be quick and easy, and everybody's on board, and the investors are excited about it. The partners are agreeing. Everything is going right from a legal standpoint. But from a tax standpoint, we have these S corporations that can't be folded in. So before we can get to the good stuff and take advantage, as we said, of these economies of scale, we have to do all these internal reorganizations and restructurings that are just very unnecessarily annoying and expensive. And what should be, a quick and easy job becomes a very laborious and expensive job because of those S corporations. If you have them, don't worry about it. We can work with them. But if you're, starting out and you're doing this for the first time, know that you can save yourself a lot of headache down the road just simply by forming LLCs for your concepts.
Great. Okay, let's move on to the next. And by the way, everybody who is listening, if you want to ask a question during the presentation, go into the chat box, send me a question, and if it's relevant or we're not going to get to it in a minute, I will certainly ask it of the panel. So now we're going to talk a little bit about how do you form the holding company? And we hear this term a lot, Andrew, holding company,
Mhm.
also synonymous with parent company. That helps people understand it sometimes. Explain what a holding company is and what it does.
Absolutely. The way I like to look at a holding company or a parent company is I like to think of it as a bridge connecting different operations, different locations, different restaurants, different bars.
Mhm.
Um, I get this question a lot. Why do I need one? Some operators act as though all the bars and restaurants that they own, even without a parent company, are one and the same. And you can borrow here and move money over there, and it's all the same ownership. So who cares? The problem with doing that, if you don't have a formal link, if you don't have a parent company over them, you're really eroding the separation between those companies in a way that defeats the point of having those separate companies anyway, right? So a parent company formalizes a structure and creates a bridge between operations that without that bridge really can't even talk to each other. You can't borrow between companies. You can't consolidate the profits. You have separate tax returns, separate contracts, separate bank accounts, everything. There's no bridge linking them. What a parent company or a holding company does is it creates a bridge between those concepts. And the bridge is very important because it does a few things. As you can see from the slides, it consolidates ownership and consolidates profits, right? So from a tax standpoint alone, this is very beneficial. You file one consolidated tax return at the holding company level. You give one set of profit distributions at the holding company level. Venture number two isn't doing so well, but venture number one is. That's fine. The profits flow up. If you want at the parent company to loan venture two money, you can do that without really risking any kind of commingling of liability or breaking down the separation between the restaurants that you spent all this money to create in the first place by creating different companies. But more importantly, it creates a common vehicle for partners, for investors, right? You're not just selling interest anymore in one restaurant, you're selling interest in three or 10 or 20. That's a much better deal. It's going to get you a much higher valuation. It gives you a lot more leverage in those negotiations. And eventually down the road, if you ever want to sell your hospitality group, you can do that by selling equity in the parent company. Without a parent company, if you want to sell everything at once, you kind of can't, and you're not going to get a very good deal. The acquirers out there who are interested in taking over hospitality groups are not going to want to negotiate eight different contracts with you for eight different locations.
Let's
They're
stop there.
not even going to be a conversation.
That's important. So we're all building these things, and man, it's hard to run restaurants. I ran restaurants, you guys run restaurants. It's exhausting. That's why I became a lawyer, believe it or not. Now, at some point you may want to sell. You've busted your ass. You have five, six really good restaurants. In the past, you may have tried to like find a buyer to buy six separate companies. These days, that's not going to happen. But if you have one holding company, one parent company that owns all of these six things, now you're out in the market and people are going to pay millions of dollars for your holding company. It's a huge difference. And the more importantly, it's how you can afford to hire great people. This is the biggest problem in our industry. How do you open up a place and be able to afford that great GM, executive chef, DO, these people? You can't because each place can't afford it. But if you have three places and you're spreading those people out amongst the three, all of a sudden you can attract the best talent. Dimitri, you have anything to say about that?
I think that's the key point is really creating the IP, the brand, and the value proposition for what makes your group unique and differentiated and what that ethos is for each location, even if the concept may be different. It really helps people buy into the vision, both as investors and employee and executive teams, and towards your front of house, back of house managers at each of the locations. And it's just become a real, growth engine across the world where there are now international hospitality groups where, exactly what you're getting once you go into one of those restaurants. So that's the big differentiator for kind of the a single or two location individual restaurant that doesn't really have that, top down value proposition.
Thank you for that. Andrew, anything else you want to say about forming the holding company?
It creates a launching platform for a lot of different things, right? And in a few slides, you'll see what a traditional hospitality organizational chart looks like, right? Around the holding company, you often form things like an IP or an intellectual property holding company where you put the brand and all your trademarks. You can create a payroll company around it for all of your shared employees that split their time between multiple ventures. You can create a management company to be owned by the founders and managers, and that itself can enter consulting or management agreements on the side. It's kind of like the planet around which you're going to create all these moons that are kind of in orbit, right? But it's the nexus around which everything kind of revolves. And without it, you're talking about, even if you own 4 restaurants, that's not, like we said, that's not really how a landlord or a bank or an investor or a buyer is going to look at it. They're going to say, all right, well, you have 4 separate deals. We'll negotiate each deal separately. They're not going to look to the left and right and see what the other restaurants are doing. But if you have a parent company, they're going to look at the whole thing and you're going to get the benefit of those shared operations as well as the discounts, right, that come from bulk sale discounts and warehouse permits and all these other things that you can take advantage of at the holding company level.
Let's get into building. Love the metaphors, by the way, Andrew. So far we have Legos and we have planets and moons. It's great.
Yep. We're getting into astronomy today. This is new
Keep
for me.
it coming.
My science knowledge is limited. These metaphors are going to fall apart quickly.
Dimitre, this seems like right up your alley.
Mm-hmm.
These particular concepts.
Mm-hmm.
Andrew, why don't you start us off and let's have Dimitre, kind of
Yeah.
work with you through
Sure.
this slide and explain, first of all, it's a term we hear a lot. Explain it in the simplest way possible. What is a waterfall distribution? Go ahead.
Sure. I'm going to zoom out very quickly before I get into waterfall distributions and say that when it comes to creating a holding company, right, a lot of times when you're doing that, you're taking existing concepts that don't have a parent company yet and folding them into a parent company. So you're taking sets of owners, which may or may not be the same, and you're trying to consolidate them and create a master agreement at the top, right, that will govern all the operations at the bottom. That is easier said than done because invariably you're going to have to create a valuation for each of those companies and come up with a consolidated organization chart, consolidated cap table, consolidated rules of the road. Most of the time, this is where the headache really is. It's actually not on the legal side, it's on the accounting side. And I'm so happy to have Dimitre here to kind of walk through this with me because as a lot of clients of ours will tell you, the sticking point of the make or break, right, in a roll up really comes down to the accounting. Can everybody get behind the numbers? Can everybody get behind the chart, the spreadsheet? If they can get behind the spreadsheet, amazing. We can deal with the legal nuance and the agreements. Those are easy. It's getting people on board with the idea that I, as an owner, might own 20% of one restaurant, but if I'm folded into the parent company, now I own 5% of five. Is that fair?
You just mentioned something called roll up. Before we let Dimitre sink his teeth into this, explain what a roll up is, because we haven't gone over that term yet.
Sure. A roll-up is basically the process of converting a bunch of different restaurants into the parent company structure that we're talking about. And it's called that because essentially you're rolling existing interest up from where it is in the single restaurant up into the parent company. It's basically a reorganization into the structure that we're talking about. And I guess getting back to the waterfall distribution, what it means is there are lots of different names for it. If you've heard of preferred return, it's similar to that. It's the idea that specifically in an LLC, you can pledge a certain percentage of profit to owners that don't necessarily correlate to the ownership that they have in that concept. So I'll give you an example. When you're raising money, maybe you're selling 20 to 40% of a restaurant's equity to a class of investors to get the concept launched. That's the typical range is somewhere in the 20 to 40%. Could be higher, could be lower, but that's about the average. What investors are going to want to know is how many years will it take me as an investor to recoup my investment? What is often done in the hospitality world is you will give investors what's called a preferred return on their investment. And that means you're pledging somewhere between 80 and 100% of the profits to that investor group upfront to accelerate or speed up their payback. And then once they're paid back, then they get the 20 or 30 or 40% that they own thereafter. Waterfalls are very helpful because it lets you be creative by accelerating that payback without giving up too much equity in the first place. Imagine if you didn't have the acceleration. Imagine if you didn't have the waterfall distribution. You might have to sell 60 or 70 or 80% of the equity to the investors to get them paid back at the same time. That's not a good deal for you as the manager, as the founder, because then you're sitting on 20% of profits for the life of the business. That's not a good deal. So this is kind of a compromise to say, look, I don't want to give away the lion's share of equity, but I understand you want to get paid back sooner rather than later, and money now is worth more than money later. So let's strike this compromise. Let's do a waterfall distribution. Let's have an intermediate tier of profit percentages that don't align with the equity percentages until investors are recouped. There are a lot of different variations of these. I've seen waterfall distributions with like 5 different tiers that have different triggers, but most of the time it's just 2 tiers. It's investors get a preferred return until they recoup. Once they recoup their capital, then it's along equity lines. That's the traditional model.
Dimitri, why don't you dig into some of this stuff?
I'd also love to
topic
add.
here is how your accountant will help. How are you
Brilliant.
going to help?
Yeah, great explanation by Andrew. And the key thing right there at the end was, the different types of waterfalls. So also just to visualize a waterfall for our attendees is it's called a waterfall because the cash flows as each stage happens, it kind of cascades down like a waterfall does. So as accountants and financial experts, we have amazing templates and protocols to help really crystallize exactly when the changes of the subscription agreement occur. And the waterfall distribution, we really prefer simpler structures. The real estate industry is more notorious for having more complex waterfall distribution structures, but we prefer for hospitality groups to really have 2 tiers, just as Andrew laid out. An accelerated payback is phase one, and then phase two is generally a slight favorance to the sponsor or the hospitality group, and then the investors, depending on the deal.
So Dimitri, we put these into usually 2 classes. I just want our clients and people who are watching this to understand how we talk about the industry from our end. And it's 2 classes. Usually it's class A and class B. Class A is the owners, meaning the people who are starting it, the chef, the GM, whoever. And class B are the silent investors.
Yes, exactly. Yeah. And then we really help with the initial fundraising document. So we help really crystallize IRR. What are those going to be at 5 years, at 10 years, with an exit, without an exit, payback
What does
period.
IRR mean, please, Dimitri?
So it stands for internal rate of return, and it basically calculates your future cash flows discounted back to what 0% would be. So it's a fancy way to understand if I put in $1 million and I get X amount of cash flows over the next 5 to 10 years, what rate of return makes all of that essentially 0%.
Okay.
So
how long is it going to take to get me paid back?
Correct. Yes. Okay. And it basically means how much like effective return I'm getting per year. So if I put in 100K and the IRR is 20%, it means that I can expect 20% of annual return over the course of my investment.
Gotcha. Okay.
In terms of benchmarks, we really like to work towards how can a hospitality group achieve a 15 to 25% IRR, depending on the concept itself. We have seen incredibly high performing IRRs on the fast casual to QSR space, and also some fine dining cohorts where they've had amazing success in streamlining their group. So the range can be benchmarked to very narrow groups that we work with. And that's where we help a lot, where we can really use our knowledge of, okay, you're overshooting over here. Investors may not quite believe your pitch deck story, or you're just being way too conservative and people will not be as interested in this
Dmitry,
investment.
don't investors usually say what I've always heard and what we tell our clients? Tell me if I'm wrong, I need to change it. But investors, when you show them your pro forma and your predictions of how well you're going to do, if they see that they can get repaid within 3 to 5 years, is that still
Yeah.
where investors are kind of their happy spot where they're willing to invest?
Yes.
Yeah,
Yes, completely correct. That benchmark is still very valid. And a lot of that hinges on how effective you are in managing your project costs up front. You
sure.
can you can often have towards the 3 year payback period. Generally, you've done pretty well on your construction budget, your pre-opening budget. And that's where we also help a lot at the beginning to make sure if you are matching up in the benchmarks on how expensively you're opening your new location.
Mhm.
Um, as far as everything else listed on the slide, we help with, the whole financial model of the group with our fractional FP&A service, which stands for financial planning and analysis. So all that means is we're really building 3 core files for our clients that help map out the growth plan for a hospitality group. So your existing locations, your growth plan by various prototypes or business segments. So if you have different verticals in your business, we will understand how to model those growth characteristics. For example, a CPG brand might have a more distinct marketing funnel than a restaurant does in terms of website marketing, in terms of digital marketing. So we understand how to basically show what a growth equity company would want to see when you're looking at, getting your group to the next level.
Mhm.
We just helped a client in New York on our fractional package that has multiple brick and mortar locations with growing different prototypes. They have a growing e-commerce Shopify brand, and now they're also expanding into wholesale where they're looking at selling into big box retailers. So all of those divisions need to have their own different growth characteristics, and we analyze the profitability of each one on where they should put more capital into. So we're really acting as that CFO layer within these groups to help both on the accounting cleanup and then on the future growth plan identity of the group. We also help then on the pitch deck to help tell the whole story and put it all together.
Let me ask you a question, Dimitri. Our restaurant owners are chefs, they're GMs, they've been in the industry usually a long time. They're industry people, but they're
Mm-hmm.
not accountants and they're not necessarily MBAs. What kind of things, what is the baseline that you think a hospitality person should understand when it comes to restaurant business and finances? Like, for example, they have to know how to read a P&L, right?
Mm-hmm.
There's different levels of how to read a P&L. What do you think, and what would
Mm-hmm.
you suggest to the people listening here? Like, go learn these basic skills.
Yeah, I think it's we also educate a lot on the balance sheet and how ROI works on a project because the P&L, generally up to like contribution margin, which all that means is you take away a lot of your variable costs in your business. So you're looking at your food cogs, your beverage cogs, your labor cogs, your semi-fixed labor costs, and then also all your variable costs such as restaurant supplies, credit card fees, third-party delivery fees. And then you have a good understanding of your controllable profit
Mhm.
and how that again can benchmark to the rest of your particular food segment and spend segment. So we look at the P&L from, you know, cover volumes, average spend, controllable profit, all the way down to then EBITDA. And then we really try to educate our clients as well to the cash flow statement. So if they are building up unnecessary working capital liability or their project cost is going to have to be retapped every 3 to 5 years. They need to be aware of the ROI of that location. So we educate on the whole financial statements a lot
Fill in the
in
following
our company.
sentence for me.
Yeah, yeah.
I'm a restaurant owner and I go to my accountant or my bookkeeper, or whoever's doing my books, and I say the following. Teach me how to fill it in.
Teach me how to make my restaurant more profitable.
Yeah, teach me.
Yeah.
What do I need to know? Teach me how
But
to
yeah,
read my
first, sure,
balance sheet.
yeah. First thing that we actually always have really focused on the last year is focus on your sales per square feet, and try get that as close as you can to 1,500. So you take just your annual sales, divide by your square footage. Sales cures all. So before you even look at like all your margin effectiveness,
Mm,
look at how you can optimize your sales.
mm.
Because often we see brands at 1,800 sales per square feet. So if you're then looking at all your margins, you may actually need more marketing spend. You may need more staff at particular days of the week to increase your sales. So I would say start at sales. Sales cures
Okay.
everything.
I like that. That's great. Andrew, you have anything else you want to say
Yeah.
about this?
No, what I will say is, with this process, if you're creating a hospitality group, as much as it sounds self-serving to say this, you want an accountant and a lawyer on your side early, and you want them talking to each other. Because what happens a lot of times in these deals is, we'll get 99% of the way, and then only then will we talk to the accountant. The accountant has a different vision for what the group should look like at the end of the day.
Mhm. Yeah.
Right. And we're talking in kind of broad generalities here about what hospitality groups look like, but take our word for it that these org charts look very different company to company, group to group, because you have different concepts. You might have a CPG line, you might have a franchise line, you might have a license model, you might have a lease model, you might have a management agreement model. There are a lot of variations here, and there is a lot of nuance to how we can structure this in ways to save money. Right? Again, the goal is always to save money, to shave points, or to increase profit points and to shave costs. So the having the lawyers and the accountants aligned is so key.
Okay.
What I like to do is start with an org chart, show it to the accountant, get buy-in, and then have the accounting and the legal teams work at the same time towards that goal, because there's going to be work that needs to be done on both sides. And trust me when I say the investors and the partners that you have will have questions for both lanes. So making sure that those questions, they're not getting different answers from both sides is really important. So
Yep.
just having kind of that initial game plan strategy meeting with all the professionals, trust me, it'll save you time and money in the long run, and it'll make the process go a lot smoother.
Yeah, no, that's the team you need. You need your lawyer, you need your accountant. Let's go. Let's open up some places. Let's move on to the next slide. So this is well, how does it work? You've talked about a little bit, Andrew. So now we have a holdco, Yippee, right? It's owned by me and my investors, and I've got 3 locations. Talk to us about how it works.
Yeah, so this is kind of a simple model of what this looks like. Ultimately, if you look at the bottom, if you're looking at the visual here, venture one, venture two, venture three, think of those as standalone restaurants, right? That's really what those are. That's what those boxes represent. Your is going to be signed by venture one. For venture two, your lease is going to be signed there. Basically, you want the contracts as much as possible to be signed by those ventures at the bottom. They're known as subsidiaries, meaning that they're wholly owned by that parent company. So, you want to keep a working capital there. You want a bank account there so that all expenses can be paid. It's the profits and the guaranteed payments or the management fees that flow up to the parent company. And that's where, the profit distributions are made. That's where the guaranteed payments, otherwise known as salaries, are paid out to the managers. But generally, you want to keep the liabilities to the extent that you can insulated at the subsidiary level. That's a very basic model. As you grow, you'll probably have payroll companies and management companies doing other things, and we can explain how that works. But this is very simply what a holding company looks like. It's just a mechanic to pool profits, to pool management fees, and let you kind of build up, like we said, that bridge
Talk
connecting
to me,
concepts that wouldn't otherwise be linked.
talk to me about management fee. We toss around that term a lot,
Mhm.
and it means different things in different situations. So when you're talking about management fees here, what are you referring to? And when you say managers, who are you referring to?
Yeah, when I say managers, in this context, I'm talking about the founders who are doing work for the company. Management fee is, in essence, a salary. We just can't call it a management fee or a salary because it's if you're an owner of an LLC, you're not technically a W-2 salaried employee. When you hear management fee, that is guaranteed payments that you are getting for your management of the concept.
Gotcha.
Um, and these can range a lot, right? If you're a founder and you're a chef who's working 80 hours a week and you don't need to hire an executive chef because you're that person, you're probably going to get a higher management fee. You should get a higher management fee than somebody who's saying, this is my 20th restaurant. I'll do 5 hours of work and hand off the work to my employees. That person shouldn't get the same management fee in most cases. Um,
When we're talking management fees, we usually kind of peg it at 5% or so of gross sales, right? Or or a minimum fee because man, we all got to eat and live and pay rent in this city. So talk to me, Dimitri, a little bit about that and what you're seeing as far as
Yes.
management fees.
Yes, that's exactly a good range. Anywhere can range from 4 to 6% as well, depending on the stage of the location growth. As you scale through, it can come down. It really is trying to break even the whole company. That's the goal. So, um, all of course, your executive management team and the whole co, and all the shared services of the business, and then an easy way to just to kind of have that entity break even is to have the management fee each period go back into the holdco. So it's really just charging back the corporate overhead, or shared services is another phrase for that, back to the locations.
Does it help, Dimitri, if let's just say venture one and two are highly profitable and venture three is taking some time to ramp up and is losing money? Does that help having a hold co where you can offset some of the profits from the good ventures against the bad one?
It helps with really just insulating the whole group. So generally, top performing groups, it's always susceptible. Maybe there's geographic risk or portability risk that has occurred, and a location needs to be evaluated on its own. And the holdco team will do the ROI analysis. Okay, how much more capital do we need to put in to try revive this location? But the structure then really helps because, of course, the whole group is helping make that decision of,
Mhm,
can we turn this location around,
mhm.
or can we wind it down and use resources more efficiently for what's working?
Great.
So it helps with, not having to consistently ask those investors of that particular location to put in capital, and
Mhm.
everyone understand that it's a diversified portfolio.
That's good to know. Andrew, do you have anything else you want to say about this?
Not at this time, but yeah, it's a good idea to think about management fees in relation to your overall labor costs. People ask me, what should my management fees be? Is this too high? Is this too low? It's hard to answer that in a vacuum. Think about what your job would go for on the open market, right? And that's a good place to start. But remember that, if you're thinking, oh, it's too high, what is your overall labor cost? If your overall labor cost is manageable, okay, then, we're probably not going to get too much pushback on that fee. You also might want to reduce the fee per location. If you're managing like 20, you're probably not going to get a 5% management fee for 20 locations versus 5% management fee for one location because even though you're not getting paid hourly, there is a component there. How much work, time, and attention could you possibly be devoting to that? So as
Right.
Dimitri said, it's a sliding scale, but also as David mentioned, having it be the greater of two numbers is a good flexible way to make sure that you have at least some guaranteed income coming up, regardless of whether there are closures, renovations, pandemics, who knows?
Excellent. Let's move on to the next one. So this is the roll up that we're talking about. Now I've got my three restaurants. I did not watch the webinar. I went and I opened up three of my own restaurants. Luckily, I opened up three different LLCs, thank God. Um, and now I come to Andrew and I say, Andrew, I want to grow. How do I roll these three separate LLCs into a holding company? Because you know what? I've got six investors in number one, I've got four in number two, and I've got like just me in number three. How on earth can I pull everybody into one holdco?
I think the simple answer there is the first step is you have to sell your partners and your investors on the idea of consolidation. You have to get them excited about it, right? Which means that, even though they're already existing investors, you have to sell them all over again on what your vision is and saying, yes, you signed on for one restaurant. Now you have to convince them to be excited for three or four or five or an unlimited number of things. It's generally easy to do that because if they started with one restaurant, they invested in one restaurant versus investing in something with infinite growth potential. So, you have to get them on board. This is where you would get your accountant involved to come up with a preliminary cap table. If everybody did decide to roll up, what does their ownership
Let me
look like?
stop. You use terms sometimes that can be a little bit confusing. You keep talking about cap table. What do you mean when you say cap table?
It's your ownership chart, right? It's a chart outlining, the amount of your investment. It's the percentage equity that you own. Basically, it's just the table of ownership that you're going to have for every company that you have.
So who owns what and how much of the company do they own?
Mhm.
That's your cap. Go ahead.
Yep. So you have to get them on board with that basic premise, right? Of you're going to own a smaller piece of a larger whole. And even though the percentage might be smaller, the value of that percentage is a lot higher. And that's generally a good thing. Most investors are excited about this. Some investors might need a little convincing. You also have to look at the operating agreements for each of your existing LLCs, right? To figure out, do you have the right to force them to roll up or don't you? Right? What are your rights? What are their voting rights? If you have a squeaky wheel investor that you don't really want to be a brand partner at the holding company level, this conversion process is a perfect time to explore buying out the people that you don't want to be in bed with long term. This is a good opportunity to trim the cap table a little bit.
How does that work? So I go to my investors and I say, I want you, we have three. Here's my plan to grow to six. I
Mhm.
want you to roll up, and instead of you, investor number one, who has 20% of venture number one, my first restaurant, I want you to have 3% of this hold co. And they say, okay, cool. And they all say yes. And then it's always the guy who's got like 1% of venture number one who says, nah, I'm not interested. How do you deal with that guy?
Yeah, your leverage depends on the contract, right? Do you have the right to force them to do this or not? Do you have the right to force them to accept a buyout or not? Most of the time, the answer is no, right? If you invested, they just get the privilege of staying where they are, and that's the penalty, right? Maybe 99% of that company rolls up into the holding company, and then you have a 1% investor who's left behind.
So that's what I'm asking. So you can roll up and leave some people in each restaurant as little dingleberries, stragglers, who can just kind of hang on and keep their little percentage and not be part of the big picture.
Can you do that? Yes. Is it advisable? Not necessarily, because even if you have a 1% partner in one restaurant, that restaurant is no longer technically a pass-through entity. And now you need two separate sets of operating agreements, two separate sets of tax returns, and you have to be careful about how you share resources between those companies. And
Mhm.
I see in the chat there's some questions that kind of relate to this, and I'll give you
We're
some
going to get to
examples.
all the chat questions, by the way. We've got a lot of them. That's why I'm not reading them, but we will read every single one of them at the end. Go ahead, Andrew.
There are, you can imagine situations where, let's say I'm an investor in restaurant one and I own 10%, but I'm paying 50% of the salary of someone who's only devoting 20% of their time to this restaurant, right? It
Mhm.
can be hard to figure out whether you're evenly dividing resources properly. If the holding company owns 100% of all your restaurants, you don't need to worry about it as much because it's one common pot. If it's not one common pot, even if you have those stragglers who don't want to roll up, those can become problematic over time
Okay.
because you have to be careful about how you share and allocate resources and you have to make sure everything's equitable. That's
Dimitri,
easier said than done because if you have shared employees, they might have one month where they devote a lot of time to your restaurant. You might have another month where they're just not visiting that restaurant because they're needed elsewhere. So it's tricky.
Dimitri, how do you convince from an accounting
Yeah.
money standpoint, how do you convince the investors in one, two, and three to roll up? What's your pitch?
Yeah. So we deal with this quite often where we're handling the different operating agreements or JV structures at the individual locations. And what we really do is just do like the exit valuation of each location. Where's everyone in terms of how much cash flow they've received or not received, and really have the definitive ending of that agreement to get them the equity percentage in the holdco, as Andrew suggested. Our pitch to them is always, this is how much cash flow we can actually pay out of the holdco once the recapitalization occurs, to just get you out of the holdco, which is generally, hopefully, it's a pretty fair amount. In most cases, it is. And at least we try get the money back to that investor because they took a risk at the beginning. And then if they want to believe in the bigger picture, there will be a growth plan document. There will be, the chance to have Q&A with the investor team, with us as the financial experts. So we try create security and confidence in the new group, and make it exciting. Naturally, when you're fundraising, you need to be in sales mode. So if there is an investor that is just not really willing to move forward, try your best to make them whole in terms of how much money they risked on you, or try get them to that IRR that they were kind of promised at the beginning. That's the best way to handle the stragglers.
Thank you, Dimitre. Andrew, give me the pitch. I'm ready to. I'm talking to an investor tomorrow. I know that I want to roll up. Give me my quick pitch to that investor and why it's in their best interest to roll up with me.
Well, you talk about the ventures they're not a part of yet, right? And you'd let them know what you have going on outside of the blinders that they have on with their single location, right? And say, hey, let me tell you about the other concepts we have under management, and then let me tell you about how we plan to expand them.
Right.
Here's the value of your equity right now. Here's a projection for where we hope to be in 5 years and 10 years. If you come with us, here's where you could be. Right. But you have to tell the story, right? And I think that's sometimes the trickiest part is selling them not on the idea of a holdco in a vacuum. You have to tell them what is the vision for your hospitality group? How are you expanding? What are you prioritizing? What are you growing? You're growing different brands, focusing on one brand. What is the story of that brand? It's honestly not all that different than pitching an investor from scratch. It's kind of the same thing.
Talk to me a little bit about this landlord and creditor consent, and then we'll move on. What do you mean by why the hell does a landlord have anything to say about this?
Yeah, the general lesson here is that the sooner you start a holding company, the better off you will be. Because it's the more standalone ventures that you're trying to consolidate, the harder that is. You don't just have to worry about getting your investors, your partners, your other equity owners on board. A lot of times you have contracts in the name of your restaurants that basically put an equity freeze on the ownership. For example, your landlord might have language in your lease saying if 50% or more of the restaurant changes hands, that's an assignment and I need to approve that. Technically, 100% of the equity would be changing hands here. The people in charge remain exactly the same. The human beings are the same, but you're technically rolling up 100% of the equity of that restaurant into the parent company. So depending on how that lease is worded or how that loan agreement is worded or how that any contract you might have is worded.
How do you word that lease in the beginning so you don't have that problem?
Sorry?
How do you word that lease in the beginning to avoid this problem?
You would exclude internal restructurings,
Right.
right? You define change of control in terms of the human beings who are ultimately in control, right? There's language that your lawyers can provide to exclude internal restructurings from that need. You're probably going to have better luck with landlords getting them to accept that language than creditors, meaning banks and lenders. Banks and lenders don't always have the leverage to negotiate those. So if you're thinking about taking out debt in the name of one restaurant, you might want to do the roll up first so that you don't need to worry about accidentally violating the terms of a loan agreement. And again, the earlier you do this, the less diligence that has to be done and the fewer potential third-party consents could trip you up. Clients that come to us saying, hey, we're opening one location, but we're relying on economies of scale. We're pitching this as this is going to be 5 locations in 5 years. We'll actually recommend starting with a holding company from the beginning, right? And bringing investors in there because it allows for faster growth. You're not going to have a roadblock associated with that consolidation and roll up because depending on how many locations we're talking about, that can take longer than you'd think to get everybody.
Okay, let's move on to the next slide because we have so much to talk about in all of these. So this is now we've got the money part. How are we going to fund this new big parent company? How do we do that?
Yeah, well, one of the advantages we talked about earlier is taking advantage of those economies of scale, right? If you're pitching investors of a parent company, you have a few locations already that you can brag about, and then you can talk about the potential for growth of all of them. That's a much easier sell. It's going to have a much higher valuation than if you're selling equity for a standalone location. So most of the time you're dealing with investors. Most of the time you could take out debt as well. Debt's a little trickier. Debt could potentially put you out of business. An investor contribution never will because payback is contingent on, your ability to pay it back. So you're really looking at either a debt financing, which I'm sure Dimitri can talk a little bit about, or
Yeah.
an equity financing, and you go to either your existing investors or new investors to put up additional money. Usually that results in some equitable dilution, but again, you'd rather own a smaller percentage of something large than a larger percentage of something small.
Dimitri, talk to us in 30 seconds about debt financing.
Debt financing is really when you're starting to hit that 3 million EBITDA plus. That's where we advise, unless you take at least 10% of your capital structure on equipment leases, which some companies are willing to help support on, which just reduces a little bit of equity need in the business. But you really want to be taking on debt when you are a more mature hospitality group with substantial cash flow.
Mhm. Great. Let's move on to the next. This is the key for a lot of our clients. This is where the juice is. This is where the pleasure of having a hold co really plays into your everyday life. And that is because it allows you to hire these different positions, DOs, culinary directors, CFOs, HR, PR, and director of development, usually in that order. Of course, there are variations on that theme. Andrew, you want to talk about that?
Yeah, absolutely. As you expand and the bigger you get, the more likely it is that you're going to have an executive team that oversees multiple or all of your locations. You're going to need that. And what this visual on the screen contemplates is you might want to form a management company. It can also double as a payroll company outside of your holding company to hire a kind of shared executive management team. So instead of hiring a director of operations 4 times for 4 restaurants, you're going to hire them once through your management company, expense all of the various restaurants for their portion of that salary, and then you're going to have a director of operations servicing all your restaurants from kind of that parent company level. The
So
reason you form a new entity is to
if your
insulate the
deal
liability.
gets 180,000 bucks, Andrew, you can split it up 60 from each place, right?
Exactly.
Okay,
No.
go
And
ahead.
yeah, and who you hire really depends on who you need, right? I mean, CFO is probably somebody you need. Maybe it's a equity partner, maybe it's not, maybe it's an employee, maybe it's a contractor. But these are roles that you need to fill. I think what's more standardized is the idea that larger groups will need to answer these needs. What's not as solidified is how you go about it, whether it's an employee, whether it's a partner, whether it's a contractor. There are different kind of ways to go about this. Different hospitality groups have different success, but these are things to think about as you're building. You want to expand your network, ask around to find the right partners to help you grow because you're going to need that executive team as you expand. You can't do it all yourself.
Right. Great. Let's move on.
Yeah,
Uh,
and
go
go ahead.
ahead.
I was going to say that the advantage of kind of creating this management team is depending on what your contracts with your investors say, a lot of managers end up leveraging their success for consulting deals that might be totally unrelated to the hospitality group you formed, right? As long as you don't have a non-compete or anything that prohibits you from doing, outside deals, we have hospitality groups that we represent that are solicited by hotels or other brands that are saying, hey, we're struggling. Hey, we want help. Hey, could you help us with this menu? Having a management company that's a limited liability vehicle gives you a platform for you and your core team to service other contracts, make a little extra money without increasing liability exposure because you have that extra limited liability vehicle. You want to be careful. You want to expand gradually. You don't want to bite off more than you can chew because remember, those managers have a fiduciary duty to your investors too. You got to make sure you're reserving time for them. But it's very common for managers to, engage in other management or consulting deals. And this was a visualization of what that looks like. And how, again, as we talked about, the holding company kind of being the planet, and all of these other companies and considerations being in orbit around the planet, these management and consulting deals can very much and often are in orbit around your central hospitality brand.
This is the most important slide, and this is the most important visualization for our clients to understand. If you have this set up, you can do just about anything. Any deal that comes in, someone comes to you with an opportunity, you're set up for it. Management, licensing, consulting, Dubai, Africa, here, there, it doesn't matter. You can do almost anything. This is it. This is the magic. It takes a minute to get there because you got to open up a couple places, but you can get there. Let's go. I think we have one more slide left. Maybe we're at the end.
Mm-hmm.
Yeah, talk about these, Andrew.
Yeah, so you might have heard us use the acronym IP. That stands for intellectual property. What that means in the context of the hospitality world is it's your brand. It's your trademark, it's your name, it's the look and feel of your restaurant, it's everything that makes your hospitality concept distinct. It's very important. And you want to make sure it's clear from the beginning who owns that brand. If you go to ChatGPT or LegalZoom or frankly a lot of lawyers that you'll hire won't address this in the operating agreements or partnership contracts. And that can become very dangerous. If you have one location, it's fine, but if you want to expand into a second location, the issue of IP will come up immediately because the question is, who are the brand partners? Who do you have to take with you and who do you not have to take with you? Most of the time when we're talking about a hospitality group, the brands are owned at the parent company level because that's inherent in the sale to investors. You're telling them that you're investing in the brand. That's the whole reason you formed that parent company. Most of the time, that's the case. But what it lets you do is create opportunities for franchise, for example. You could hire somebody else to manage locations 3 through 7, and that's money into the IP holding company, which is money into the ultimate holding company for the betterment and profit of everybody. So the IP is an asset you want to protect. Generally, as you grow, you want to park it in its own vehicle along with the trademark to protect it and insulate it from any liability. But it can also be, just like the management company was, an arm of your hospitality group to target deals that you might not be able to otherwise in the form of licensing and franchise deals.
Absolutely. Very, very important. All right. We have a lot of questions. I want to ask them all. So this is over time. Tyler, you can take down the PowerPoint. We're just going to be talking heads for a while, and we're going to go through the questions from start to finish. You guys ready? This is like hot seat time. Dimitre, you ready?
Yeah.
If you've started an LLC for the original location, but not defined the standing of the IP, how do you address the IP in starting a second location with completely separate investors, given that the first investors have forgone their FRR? Andrew?
That is tricky. If you haven't defined IP in your first operating agreement, the typical default is that first company, and by extension its owners, own the brand. So you technically can't expand the brand without doing right by the original owners of that brand. If you want to expand with new investors, it's risky, right? Because we've seen lawsuits happen around the idea that is a violation of fiduciary duty. You're not following the corporate opportunity doctrine, meaning you're taking advantage of an opportunity that should be reserved for the initial owners. And now you're expanding it in a way that's self-enriching with a whole new batch of people.
Yep.
If you want to do that safely, in a perfect world, you would get permission from your existing investors and you'd probably structure some kind of licensing deal where the second location pays the first location a licensing fee.
Yeah.
It's a little murky though, because there's no law that says you're fine as long as you pay a 3% fee, right? The investors of your first location might say that's not enough, or I don't like that, or I'm suing you anyway. So, you can offset the risk a lot by trying to structure some kind of licensing fee arrangement, but it's tricky because the investors in the second location won't like it because that's points off profit immediately. And the investors in the first location might not be satisfied with it, might not think it's enough. So, you either want to get them on board with that licensing framework and get signatures and waivers, or for anybody who's really a stick in the mud, that's when you think about potentially negotiating a buyout and saying, look, this is great, but we're not going to be able to expand the brand with you unless you get on board with this. If you don't want to get on board, here's some money. We'll see you later.
Mm-hmm. Thank you.
Yeah.
Next question. How do you feel about employees being employed through the management co versus employed by each unique operating entity? How do you handle employees working at multiple locations if they are employed by the operating entity? I have concerns about class actions and other employee claims bringing in all locations.
I can provide some context on that, but generally you want to, if it's very early stage at the brand and there is some shared work across a general manager to another location, clearly they are some of your important staff. So you can already start thinking of who is going to get promoted into the holdco and the executive management team, where perhaps they become a regional manager, or heading towards the decision of who's going to be my director of ops. But generally, there's that transition period where if someone is working across two locations, you can just create simple time allocations on the P&L for those team members until you make a decision about the holdco. Generally, you want to keep the holdco as that promotion target for GMs that are doing a great job.
Something else that you want to think about is if they're splitting time between multiple locations, you don't want to have them be employees multiple times, right? You want to have one W-2 for that employee. So generally the way to do it is to hire them through that management company that services all your entities. Remember that in New York City, I think the exempt overtime threshold is 64,000 and change. You basically have to make, if you make over that amount, you're not generally eligible for overtime compensation. But let's say you make 100K, okay, you're exempt, but you are hired twice by two different restaurants. Now you're a 50K employee twice. That's a landmine, right? That's a minefield of potential labor liability, because they could argue, hey, I worked overtime at this restaurant, I didn't get paid for it. You could say, well, you're exempt. No, not according to that W-2 for that restaurant. So you want to make sure you're hiring people once, and having a shared management or payroll company that services everybody is really important for employment compliance. We have an employment group and team here that can speak to that much better than I can. It can probably give you way more war stories about, compliance risks than I can, but it's something to think about. And generally, if you're servicing multiple locations, you want to make sure you have some kind of centralized payroll company.
Okay. Another question. Does a separate LLC for each location still insulate each location from the liability of others if you're running a consolidated payroll via the holdco or a payroll master co?
Generally, I mean, it depends on the liability you're talking about, right? If you're talking about employer liability, if you have a master payroll company, it's the same insurance anyway, right? Like you're going to be insured for all the restaurants, all the operations you have. That payroll company is going to have its own insurance. And if you do it, structure it the right way, the payroll company is going to be removed from the actual operating entity and the holding company. It's really more of an insurance question, making sure you're insured properly. But it's still worth having a separate LLC, because even though the employment contracts might be consolidated at that payroll entity, your leases aren't going to be, right? Your leases, your vendor contracts, most of your day-to-day liability is going to be insulated at the location level. You're right, though, that as you service larger contracts and maybe as you sign larger vendor contracts, that management company might start getting exposed. But your umbrella insurance policies are going to cover everything. So the risk, I don't see it increasing the risk in any material way. I think if anything, like I said before, trying to keep employees artificially locked to the subsidiary levels is riskier than just having a centralized system.
Dimitre, here's one for you.
Yeah.
Can you give the broadest numerical range of IRRs that you have seen from mom and pop restaurants operating in the black to a booming fast casual brand? This would give context to those of us building performance.
Yes, we often get asked this as we do financial pro formas and pitch decks. And some mom and pops can definitely, with a very loyal customer base, actually have pretty high IRRs. So if they're looking to expand and really become a little bit more institutional in their growth plan, some of those IRRs we've seen from 20 to 40% on the successful mom and pop locations, just because they're really filling up a lot of their day parts and their sales optimization, which really helps. And perhaps they've gotten a second generation site that wasn't that expensive to maintain or to operate. So to give you a broadest numerical range, that is definitely achievable on the mom and pop side. More commonly, it's probably between 10 to 20, kind of in that mid-level, success level where perhaps there are some things that are not yet optimized to fill up the demand for that first site to then grow into location 2 and 3. If we look at some booming fast casual brands, let's use one of the largest deals this year, and this is public knowledge. Dave's Hot Chicken is famously known for actual IRRs of like 50%, and then some other brands in those cohorts can also be around that like 30 to 40% range. That means payback periods of 2 to 3 years. So what they have really focused on at their core is amazing sales per square feet. So, and reducing cost risk. So a lot of their locations are cheap to build and ramp up sales incredibly quickly. Of course, you can always improve by 3 to 4% COGS or labor points, which they also optimize, but it's much easier to optimize when you have the sales. And what we've really seen help drive that is amazing organic marketing. So something that makes you stand out without necessarily have to spend a lot of marketing dollars. For Dave's Hot Chicken, it's these beautiful murals and amazing digital marketing. For other brands in the UK, we've seen expanded marketing budgets on creating YouTube channels, on creating amazing Instagrams, on user-generated content. So I want to really stress that sales is also really important when looking at IRR. That really helps get you to that upper echelon of what is really actually achievable if you work hard is 30 to 50%.
Mm-hmm. Thank you for that. Here's one for you, Andrew. If all the subs, meaning all the sub LLCs, have different gross sales, how do you figure out what the management fee or what they should be contributing to those employees that are spread out amongst the three? Or maybe Dimitre, you can even help answer this.
Are we talking about the management fees payable to owners or the salaries payable to?
Salaries paid to shared people like the director of operations or the culinary directors. Let's just say you have three LLCs. One restaurant's got 2 million in gross sales, one's got 4, and one's got 8.
Correct. If the subsidiaries are wholly owned by the parent company, it doesn't matter as much, right? Because it's all one pot anyway. You could theoretically have one restaurant pay 100% of the salary of an employee that services all three. You don't necessarily want to do that. That might not be the most prudent choice, but legally you could. This gets troublesome where you have different partners in different locations because then it has to directly correspond to the time and value that those employees offer, right? Those locations. If you have a GM who's spending 75% of their time at location 1, and then you have location 2 and 3 paying 33% of that, you're going to have an issue if you have partners over there because they're going to be overpaying for that GM. So it really depends on what the ownership looks like. But if the ownership's consolidated and you have the subs that are wholly owned by the holdco, it's whatever makes sense, right? It's money's fungible. So, you might have one location pay 100% of one salary and a second location pay 100% of a different salary. It all comes out in the wash at the end. Dimitre might have a very different answer though.
No, completely correct. To give a bit of like tangible client discussions we've had around this topic recently, like a fine dining client with a lot of different business segments in the UK, had this kind of point where, if the time allocation perhaps to a lower performing location, a lot of the time is spent over there. So what is the true profitability of that location? And our answer as like financial experts was really that we just want to have a baseline as a percentage of the sales of the location as a rule of thumb. And then we look at EBITDA four wall. So that's how is the restaurant doing on its own. And then we have net EBITDA, which is after management fees. And then we kind of roll back the management fees into the corporate holdco. And then we see how close are we to break even across our location base at the holdco. So to handle the discussion of allocating the management fees per entity, sales is the easiest, or sometimes we use number of staff at the particular locations. if they have relatively similar revenue levels. But if there's different concepts entirely, where your AUVs double or triple, percentage of sales is the simplest methodology to at least understand, okay, what should be your profit levels. On average, the exec team helps everyone relatively equally over the course of 12 to 24 months.
Mm-hmm. Wonderful. Well, that concludes the questions, which also concludes the webinar. Thank you, Dimitre, for being our
Thank
special.
you both. Thank you, David.
Always a pleasure to see you. Folks, thank you for joining us. We really appreciate all of the questions and the viewership. If you have any questions, you can always email me, david@helbraunlevy.com, Andrew@helbraunlevy.com. Dimitre, you want to give everybody your email?
Yes, it's my first name, Dimitre, at paperchase.ac. And I'm sure we'll also send a follow-up note to all the attendees as well with some reference materials.
Awesome. Thanks, everybody.
Thanks, everyone.
See you soon.
Thank you, Andrew. Thank you, David. Bye.